Welcome to This Explainer. Today, we're taking what usually feels like a really complex financial concept and making it incredibly clear and actionable for you. We're going to dive deep into a topic that honestly feels totally out of reach for a lot of people, and that's building actual life-changing wealth. We'll be looking closely at the blueprint for wealth through systematic investment plans. If you've ever felt overwhelmed by the stock market, or maybe you just thought investing wasn't for you, well, This Explainer is going to completely change your perspective. Let's jump right in. So, do you think becoming rich needs lakhs of rupees? Honestly, ask yourself that right now. Because there's this massive, widespread myth out there that in order to make money in the markets, you already need to be sitting on a mountain of cash. It's this idea that investing is strictly a rich person's game. But what if I told you that is entirely false? What if the secret to building substantial wealth in the future doesn't actually start with a huge inheritance or winning the lottery? What if I told you that even 500 rupees a month can help you build big wealth in the future? I know, it almost sounds way too good to be true, right? But yes, absolutely. With a mutual fund SIP, small investments can create really big results. Today, I'm going to explain exactly how this works in the easiest way possible, just relying purely on the math and the structure of what we call an SIP. First off, let's understand what SIP actually means. SIP stands for Systematic Investment Plan, and the really key word here is systematic. It simply means you're investing a fixed amount of money regularly into mutual funds. You could do this weekly, monthly, or quarterly. Think of it kind of like a subscription service, but instead of paying for a streaming platform every month, you're paying your future self. It is widely considered one of the absolute easiest and smartest ways to kick off your investing journey. Now, before we can really grasp the power of an SIP, we need to understand exactly what you are investing into. So before SIP, let's understand mutual funds. A mutual fund is basically just a giant pool of money collected from many different investors. And honestly, the best part? That money is managed by expert professional fund managers. You literally don't have to pick individual stocks yourself. These experts take that pooled money and they invest it across various assets like stocks, bonds, and other securities. To put that into perspective, suppose 1,000 people decide to invest their money together. You might invest 1,000 rupees, another person might put in 5,000 rupees, and lots of others invest whatever they can afford. When all of those relatively small individual amounts are combined together, it becomes a massive, really powerful fund. A professional manager then steps in and handles all that collective money to generate returns for everybody. And it's exactly this teamwork approach that makes investing so incredibly accessible and easy for beginners. Section 1. How SIP works, the mathematical proof. Okay, let's understand this with a quick example. Suppose you decide to invest 5,000 rupees every single month through an SIP. You commit to this and you continue doing it without fail for 10 straight years. For the sake of the math, let's also assume an average return rate of 12% over that entire decade. So over those 10 years, putting away 5,000 a month, your total invested amount out of pocket is 6 lakh rupees. But thanks to that 12% average return, the future value of your investment isn't just the 6 lakh you put in. Your money can actually grow to around 11 to 12 lakh rupees. Your money has practically doubled simply because you gave it time to grow. That right there is the undeniable power of compounding. Your money starts earning money, and then that money earns even more money. That is the magic of compounding in its absolute purest, simplest form. Your returns literally start generating their own returns, creating this incredible snowball effect of wealth generation over time. Section 2. The 5 benefits of SIP. So here is a really clear overview of why SIPs are just so powerful. First, you can start with a really small amount, literally just 500 rupees. Second, it builds this amazing habit of disciplined, regular investing. Third is that power of compounding we just talked about, where long-term investing creates exponential wealth. Fourth is rupee cost averaging. And fifth, it's completely beginner-friendly because there is absolutely no need to try and time the market. Let's actually dive a little deeper into benefit number 4, rupee cost averaging, because this concept is a total game changer. It turns market anxiety into a straight-up advantage. When you invest a fixed amount every single month, you are buying into the mutual fund regardless of what the market is doing. When the market is low, everything is effectively on sale, right? So your fixed amount buys you more units of the fund. Conversely, when the market is high and expensive, your money automatically buys fewer units. Over time, this perfectly averages out the cost of your investment. It basically means you never have to panic when the market dips. Section 3. Action Plan.
Important things before starting.
Now, before you go and invest a single rupee, you've got to remember these three things. Step one, define your goal. Are you saving for a house, for retirement, or maybe a new car? Step two, choose the right mutual fund. Do a little bit of research or maybe consult an advisor to find a fund that actually matches your specific goal and your personal risk appetite. And step three, stay invested for the long term. Remember, an SIP yields the absolute best results when you pair it with a whole lot of patience. Because at the end of the day, an SIP is not magic. It is simply discipline plus patience plus consistency. There are no get-rich-quick schemes here. The real secret is just to start small, stay wonderfully consistent month after month, and get out of your own way so you can let compounding work for you over the years. Which brings us to the most important question of this entire explainer. Have you started your SIP yet? You know the old saying, the best time to start investing was 10 years ago, the second best time is today. It's time to take the knowledge you've gained here and put it into action. So, let me know in the comments down below, have you started your SIP yet? Start small, stay consistent, and let compounding do the heavy lifting for you. Don't forget to like, share, and subscribe for more finance content where we break down complex topics into clear, easy steps just like this one. Thanks for hanging out with us, and we'll catch you in the next one.